Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is December 11th, 2024, and today on our call we have the CEO, Cameron Watt from Intouch Insight. Intouch trades on the TSX Venture Exchange under the symbol INX, and it also trades on the OTC under INX SF. The company is currently trading at 59 cents with about 25 million shares outstanding, or about a $15 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. Cameron, welcome back. We had you on a while ago. So great to get you back here. Companies look like it hit an inflection point here in Q3. Some nice numbers to talk about. So there's obviously lots going on. So happy to have you back to give us an update. Before we get into sort of any updates, why don't we get a better refresher of what Intouch is all about?
Sure. You know what, I could use big language like we're in customer experience management, and then people wonder what that is. So I'll give you my cocktail party pitch. People say, "What are you doing?" I'm having a beer, and I always explain that we work with large brands to make sure that when you go out in the world, you have a better experience than you would have had otherwise. So our target industries are places like grocery stores, convenience stores, restaurants, hotel, anywhere where people go and have an experience. We work with those brands to measure how they're doing from their operational execution standpoint. We measure how they're doing, how their customers feel about it, and how their customer experience is going. And we give them tools to help them actually operationalize change and make things happen. So we really work to make sure people can get a better experience. You know what? I'm going to play a quick video for you it's kind of a compilation of some testimonials that our customers did for us. It's very quick, it's only a couple of minutes, and maybe that will help anyone who's new to the story get a better feel for kind of what we do and what value we provide. And maybe if there's questions from that, you can ask me from there. Does that make sense?
Yep, absolutely. That'd be great.
Here we go.
Working with a company like Intouch Insight gave us the ability to ground ourselves in what the customers are thinking. What do my customers want? How do I make them come back more frequently? How do I drive an ROI? How do I increase my sales and my business? And that's really what they helped us to do throughout this entire process.
The pain point that Intouch solves uniquely well is a very robust and professional approach to large-scale sampling. Intouch has the ability to go out into the field and gather that information about how we should go forward.
Partnering with Intouch Insight was an incredibly powerful decision. It absolutely created an extra layer of value in our business model.
By putting this program in place and the focus around late night, we've seen an overall increase in sales from 3 to 5% all day growth. If we break out the late night day part, one of my markets has been up over 40% year over year. That is incredibly important to us.
Before Intouch, we had a different mystery shop provider, we had a different audit tool, so you have to go source the information from different areas. Really having all that information in one repository makes it very easiest for access to data and get the information we require.
Intouch made launching all the programs super easy. The training that they provide and the patience that they've given us to go through and learn the processes. I would say flexibility and training are their two strongest suits.
They were extremely professional. They were extremely knowledgeable. They were extremely capable of all the things that we went to them and asked for. They were able to produce and quickly turn around.
My experience working with the Intouch Insight team has been nothing other than 5-star. And Intouch Insight was absolutely one of the best decisions I've made in the last year.
So, one thing I'll mention there is that Heritage Partners you might not have heard of, because what he is a very large franchisee of both Wendy's and Papa John's. So, in terms of the space. So that's what we do. We make it so you get a better experience out there. And our key products, I guess I should mention, are mystery shopping and site audits for data capture, as well as customer satisfaction surveys and forms and checklist automation for the SaaS products.
Maybe give us an understanding of how you actually go and gather the data. These are products, but how do you gather the data and how do you provide them at the end of the day to your customers?
Yeah, so we have tens of thousands of independent contractors across North America. And we use them to go and do site visits effectively. Think about boots on the street, right? We can provide boots on the street, which we do. So if you want somebody to go out there and check and see how your store is doing from a mystery shop standpoint, meaning how's your customer service when no one's watching, we have people, coast to coast to coast to coast, I guess, in this case, and we send out, and the business model is solid because it's an independent contractor model. And it's piecework. And that's why the pandemic, frankly, didn't put us out of business, was that we were able to shut off a lot of our cost structure at the same time our revenue stopped. Things got bad. The revenue's tied very closely to costs on much regard there. We also send people out to check, for example, responsible sales. We will send people out who are between the ages of 18 and 25 to make sure they're getting ID'd, right? Which is regulatory type of things. We do audits where we go, and might not be a mystery shop. We may go and show up with a letter of authorization from the head office and say, hi, we're here to check on things right now. And we'll walk around and check temperatures, and we'll check expiry dates, and we'll check cleanliness, and we'll do whatever they want us to check. So we effectively, have a team of people that work on a piecework type basis across North America that can operate on an ad hoc basis. And that we're also spinning up now that merchandising division under Ardent, which we're retooling. And it's been a big story this year where we came out, market didn't like the way we did it. We're retooling to come out in the new year in a different way. But it's fundamentally going out, the same type of thing, feet on the street, but using an employee model instead of independent contractors, albeit potentially, part-time, temporary. They would be hourly, or they would be paid on a W-2, it's called, which is equivalent to a T4 in Canada. Because we don't want to be in violation of independent contractor legislation with the work that we do either. We want to make sure that we're on side with all government bodies, which we're very careful to do. And that will allow us to do work that's more complicated out in the streets than a independent contractor might be able to do. So really, we're able to do anything inside a building that somebody needs done, and we can do it inside 1,000 buildings at the same time. Which is difficult for large chains to manage. And we manage that process for them. How they get the information, the second part of your question, is we have our own proprietary technology. So whether you're buying a mystery shop program from me, whether you're buying an audit program from me, if you're using my SaaS products, such as Intouch Check or Intouch Survey and collecting surveys or checklists, all of that data goes into what we call Intouch Intelligence. And it's a proprietary platform hub that sits in the middle. And it produces reports and analytics, downloads, and there's access to it for everybody. It has triggers and alerts and notifications. So, for example, you can put a threshold in there. You're the director of operations. You can say anyone who scores less than 80% on the following or gets this question wrong, I want an email, right? With that PDF of that report in my inbox, and that just happens, right? So that's. Oops, that's what goes on there.
Gotcha. Cameron, geographically, where do you guys operate? Is it just the US? Is it Canada? Is it both? Are you outside there?
We do not operate, well, so that's an interesting question, actually.
Mm-hmm.
I mean, this year we're about 83%, I think it is, in the US, the rest in Canada. So we are mostly in the US and Canada. We are pretty much North American based. We do work sometimes in Alaska and Hawaii, which you kind of have to count as the United States.
Mm-hmm.
We don't have our own people operate anywhere else outside of North America because we're not an expert in where to find bodies to do work in India or Asia or Rotterdam for that matter. However, we do work outside of North America. We do have the odd customer buying the software because obviously software can be anywhere, although we don't focus sales outside North America. But we've done a program this year for a very, very large multinational chain in the QSR space, quick service restaurant space. And we went to 7 or 8 different countries to collect data because they wanted to do benchmarking across different countries. And we're working on another one right now with a large beverage manufacturer to do something similar. In those cases, we partner, we have access to a very large network of companies like ours outside of North America, and we simply partner with those companies.
What does a typical customer look like? You mentioned, quick serve restaurants a fair bit. Is that a high portion of your business? What else do you sell into?
Our 2 largest parts of the business are quick serve restaurants and convenience stores. And we also have a fairly good presence in retail. We have a very large automotive piece of business with that we do as well. But the reason the quick service restaurants and we also have grocery, I mean, we're everywhere. And we have dentist offices. I mean, like we have apartment rentals. Like if you can name it, if it's a service, we probably do it. But the reason that QSR and convenience stores make up a fairly large percentage, or they're the largest two, is that if you think about it from a pure volume of locations, right? There's just so many of them.
Yeah.
And from a need to execute, and keep standards. And if you think about your own situation out there, those are places that often need feedback, right? On how they're doing and on what they can improve. And so those industries lend themselves very well to what we provide. But there's lots of other industries, obviously, and other things out there as well. But those are the two that we probably have the largest foothold in. We're also considered thought leaders in both those industries. We produce industry studies. We speak on main stage events. I spoke on a couple of different conferences, three actually different events this year. Another member of my team spoke at another event. And we don't get paid to speak. These aren't like where we're paying to go on a stage. We're asked if we will present on these stages as industry experts with our data and our studies. So yeah, so those are probably some of our key industries, and that's why.
Okay, awesome. Okay, so yeah, this was a good quarter. You guys, your revenues were up nicely, profitable this quarter. SaaS revenue growing nicely. What happened? What happened this quarter?
Honestly, nothing new or out of the ordinary. I had a lot of people say, well, I thought I had more time, in terms of, it's like, I said, hey, you should buy the stock. It's ridiculous. I was trading at 0.35, 0.4 times revenue. I'm like, why aren't you buying it? And then, of course, when it popped up to, they're like, oh, I thought I had more time. And I'm like, well, first of all, you do, because it's still only at 0.6 times revenue. It's not like it's, got some big, huge number behind it. It's trading below where we were trading when we were 19 million. And now we're, 26, 27 million. So I always tell people you still have time, but yeah. So did anything major happen? No, look. The storyline, and I'll thread it through for you, but it's all there if you just read all the MD&As and everything. We acquired last year Alta 360 and Ardent. Ardent was a startup business, right? And we were going to do a land grab with Ardent, right? So we set out in the beginning of the year. We said, look, we're going to get hyper growth, like lots of growth, like 30, 40% type growth numbers for the year, but we're not going to make any more money. Okay, we're going to go and take a land grab on this business. The market said to us, yeah, we're not interested in that so much. Okay. The market said the market was like, yeah, that is so 2019, that's so 2021. And so they said, yeah, we're interested in profits. We're interested in the bottom line. And we want growth. We want responsible growth. We'd rather have profits. So we retracted. And we said, okay, we will make the adjustments to what the expectations for the shareholder in the market is. And we said, we're going to be shutting down Ardent in its current form because, there's no point in getting in millions of dollars in revenue if you're not making money, if nobody wants you to be doing it. So if you look at the Q3, for example, there's no Ardent revenue in there. Okay. Margins are up by, 7 or 8%. And there's no Ardent revenue. It's pure core business revenue. And so, is that a good thing? You could argue it both ways, right? But it's what was asked and it's what we delivered. We delivered a strong quarter without Ardent, and we delivered strong numbers to the bottom. So what does that look like going forward, though? Well, that looks like going forward, we understand that maintaining a level of profitability is important. Okay, are we going to be burning the furniture? I won't say which company, but when I worked at one of the Fortune 100s, and when we got to December, we used to be like, oh, are we burning the furniture this year? Which is really our way of saying, are we just like, damn the torpedoes? We have to make a number for everyone's bonus at the senior team, right? And then we'll figure out what to sit on in January because we burn the furniture. We're not doing anything like that. Like we're not pulling everything back. We're not doing anything that would hurt the business or its ability to grow. But we've hunkered down a little bit, and we stopped some of the investment in some of the things that weren't making money for us. Right. And so we are coming up with a little bit more responsible growth. Ardent is relaunching. We are going to be bringing it back out next year. I can't tell you what month we're going to start seeing revenue. Okay. But we are bringing it back out. We do expect to have revenue in 2025, but that revenue will come with a margin, with a bottom line, I guess, that's more acceptable. Okay. So that we're not just doing it for a land grab. It might be slower millions being added, but they'll come with money dropping to the bottom line. right? So we're going to come out with that. The business itself is going to continue to be responsible. We're going to continue to be, profitable in terms of making sure that we're going the right direction where people want us to go. Does that mean massive growth next year? Maybe not, considering we have to overlap $3 million in Ardent revenue that I'm not going to repeat, right? But that's okay. If I stayed flat, replace that money with profitable revenue, everybody was going to be better off, right? And so that's where we're focused. We're focused on how to just get that, making sure that the ship is bulletproof, and that we're going to move forward that way. So we didn't really do much different in Q3, except that Ardent went away and we refocused on the core business and making sure that we were tuning the business to be, not investing in pure growth, but investing in things that were longer term, sustainable and profitable.
Perfect. Listen, for those that are listening, as always, if you guys got questions, please use the chat function and I'll ask Cameron as we go here. Do you envision kind of the level of business right now? Is that sustainable? You mentioned the word growth. Should investors look for some form of growth here, or, I'm trying to come up with the right question here. Is there lumpiness in your business, or are we sort of on a track here that people can sort of look to continue growth?
We have, outside of a little blip called the pandemic, we have grown consistently over the last decade. Do we expect to have the odd time period where it doesn't look like growth? Which maybe, but this business absolutely has sticky clients, and it has the ability to grow. Particularly when you consider the fact that, in the pandemic, 70%, Q2 of 2020, we lost 70% of our revenues. Right. Imagine if we weren't valued by our clients and they didn't come back, right? We would not be where we are today. Did the odd person have a problem and have to stop? Sure, right? Because everyone had their own financial issues. But bottom line is, the vast majority of our clients' programs came back, right? And they didn't have to come back. Once they'd stopped and they were no longer in the budget and they were no longer in the bonus plans and they were no longer on the slides with the executives, they didn't have to keep doing the programs and getting the data. Right? They came back. So it's sticky. It's good, solid business. It's important. And, you heard from people in the video, it's important. And so all we have to do is just keep getting more, right? And we have some of the best technology out there. We're continuing to invest in our technology. And as we start getting more market share and more clients, we tend to get more than we lose, because we are good and our clients are sticky. The only place where it might look lumpy, and I've been very candid about this everywhere, is that I got, if I'm going to overlap, like, I've got $3 million almost this quarter from Ardent and $3 million in the next couple of quarters from Ardent, right? And if we've shut that down. So is Q4 going to look like some massive growth number over Q4 2023? No, because there's a $3 million Ardent nut that wasn't making any money that we intentionally shut down, right? Is the year going to have growth? 100%. Right. Same thing I'd look at next year. Do I expect to be trying to deliver growth? 100%. Right. What does that look like in a year where you're overlapping money that you walked away from intentionally? Like when you walked away from 12% of your revenue intentionally, you have to, that's a different type of growth number. But you start thinking longer term, right? And you start thinking, there's absolutely growth, and our goal is 100% growth. For the business, we're not looking to just be stagnant and start throwing 10% to the bottom line and paying dividends, and we'll be a bank stock with a $25 million business. I mean, that doesn't make any sense. So that's certainly not the goal right now.
Right. And do you, you're still a small company, somewhat limited resources. Do you have what you need to continue to sort of go with this current plan, or do you have to go back to market to raise money? Is there people you need? Is there anything sort of missing at this point?
No, we're in pretty good shape, to be honest with you. I think that's one of the things that the market's react to a little bit too, is they're realizing, people have looked at some of the things we've done. And, I was saying to people before, when we were losing a little bit of money because we were staying EBITDA positive, and I was like, guys, like, we're managing it to cash flow. We know what we're doing. We're not, and if you look over time, we haven't diluted, right? The only raise since the company went public in 2002 was in the fall of 2017, when we raised some money to get into the SaaS business, to get into the software business, right? And it was for the initial development and entry into the SaaS business, which we then lost money in 2018 as we raised in 2017 and started spending it in Q4 2017, spent it through 2018. So we lost money for about 5 quarters as we did what we said we were going to do. And then we entered the market, right? And, we haven't raised a dollar since. The SaaS business, is it a hockey stick? No, but it's growing every year very nicely. It is now on, current run rates, 1.6 million in pure SaaS. Plus I've got the event marketing automation, which has another $1 million in SaaS revenue coming from it. And all of that is off our technology that we've been investing in. So, and by the way, if I didn't have that, if I hadn't, people say, well, you invested, like, you raised some money, invested, was it worth it? And my answer today is 100%, because if I didn't have that, I'm not sure we would have made it through the pandemic as well. Because what do you think most of the revenue I did keep was? Right? It wasn't services. It was all that software revenue from the event marketing and from the SaaS products. So yeah, investing in that technology and being able to have that timing, it turned out to be pretty damn good in terms of the investment. But we don't raise money. We don't dilute. We don't have to. I own too much of the company to dilute, particularly at current pricing. I just simply won't. One of the litmus tests I always use for if I think the company's valued well or not is when I go raise money if I want to do an acquisition, right? Because you ask, where could you use money? Hey, look, I'm sure there's more acquisitions I could do if I could use my stock as equity. Not have to worry about, because we've been doing bank debt, if you look at it, right? Like we're actually buying things using traditional debt. Which, by the way, is also the sign of a very stable, financially stable company. If you can get banks to give you money to buy things, right? And that's what we've been doing for the last couple. And but would I go use my stock to go buy a company right now? I wouldn't. It's not. It's the value's not. It's too low, right? So yeah, would I love to see that stock at a level where we could, if we get an opportunity for some acquisition, we could do it with a nice equity raise, where it's accretive for everybody? Sure, that'd be fantastic. But we're not worried about that because we don't need cash to fund ourselves. We don't need cash to grow. We don't need cash to keep developing our products. We would only need cash for some big activity, and I'm not willing to do it right now. So that because I'm cheap and I own too much of the company.
Well, to that point, insider ownership. What percentage of the business is owned by insiders?
Close to 30%. I'm the largest shareholder in the company is actually Eric Beutel. Who's our chairman. I'm the second largest shareholder in the company. And he's over 10, but I'm at 9.9 something, because I own a lot of it in tax-free vehicles. Because I'm not a founder, keep in mind, right? I'm not the guy who got free shares and I got diluted down to 9%. I'm not the guy who got penny stock, right? I was buying in the open market. My average price until recently, I was underwater with the rest of my shareholders, right? And so I bought all my stock like everyone else in the open market, believing in the company, and which is great. But I never thought I'd wind up owning as much as I did. So as I bought it, I was putting it into a lot of tax-free vehicles. And so now I'm hamstrung. So when the stock was trading recently at 35 cents and 38 cents, and I was just banging my head against the wall going, man, I can't even buy any. But it's okay, because we have some pretty solid insider ownership.
Fantastic. Let's talk about sort of the go forward plan, new initiatives. Is there anything kind of on the drawing board now that you're excited about?
Things that I could talk about probably are just the general. We're going to continue our thought leadership campaigns in the industries. We're actually getting asked to do even more studies and engagements with people out there in the industries that we serve. We've got some new stuff coming out even around the pizza industry soon. We've got some pretty cool things in the works. We're continuing to work obviously with our customers on the organic growth plans, and we're also we're still taking a real solid run at getting Ardent back out as well, with to get that revenue growth back, with profitability attached to it. So it's a lot of the same old, but being executed very well, and just continuing the plan, the path that has been kind of gotten us here.
And then you sort of touched on this a little bit, but you're cash flowing. You've got cash. How does an investor look at how are you going to allocate that capital? Where's the best use of that cash right now?
Well, I mean, obviously, when you have cash, you got a few places you can put it.
Mhm.
You know, one of them is we were spending it investing into product management, sales, marketing, those type of activities. We've throttled some of that back because we want to be putting it down to the bottom line from a profitability standpoint, and those things affect profitability. So the other uses of cash, which do not affect profitability, you know, are paying down debt, which obviously is something that we'd like to do more aggressively because, you know, the cleaner the balance sheet, the more you can go do something else without equity if you want to. We also, the other use for additional cash would be, we've talked about if the stock price ever decides it's going to be silly again, that we would have to look at doing an NCIB, which we've done in the past. Pre 2017, we did the raise. We actually had an active NCIB for a few years. So we would look at uses of cash for things like that. So, you know, there have to be, and of course, then there's just building up cash for potentially another acquisition. So, you know, the uses of cash right now will be for things that don't impact the income statement, you know, but that it could, but income that, but do benefit the shareholder or the future growth and stability of the company.
Gotcha. And then challenges, what sort of keeps you up at night right now?
Well, you know, the Americans are keeping things interesting, aren't they?
Darn Americans, yeah.
I mean, you know, it's remarkable to me that every 4 years, everybody holds their breath and we call it the election cycle.
Yeah.
You know, it's like we didn't know it was coming. And so, you know, what the reason I care is my customers care, right? And they pull their horns in and they wait to see what's going to happen. And then regardless of what the outcome of the election is, everyone starts to relax again and they start moving forward, right? With whatever that is. So I think that I'm feeling a little better, to be honest with you, about, you know, like this year was, some of the difficulties this year were to do with just people in America all holding their breath, including our customers, and in terms of making decisions, making plans, moving forward. You know, the economy is looking better right now in the U.S. Things are looking more positive in terms of how the businesses are looking at the outlook for next year. So that has definitely been a concern that's been keeping me up. It seems to be alleviating itself. You know, I'd like to say the state of the dollar is a concern, but actually it benefits me a great deal, because with 80% of my revenue in the US dollar being where it is does not hurt my Canadian dollar revenues. But I don't like it where it is because of the sustainability of it. You know, it's something you don't want to rely on. So, you know, all those macroeconomic things are things that I've been looking at. But at the end of the day, I don't have a lot keeping me up right now, Paul, because things are going along pretty well. The biggest thing that we focus on and worry about as a business, and I don't think it'll change, it was like this 3 years ago, it'd be like this 3 years from now, is just, you know, finding new ways to get new customers, right? Just to getting towards that growth.
And like it seems like you've got now, I'd say a little bit more stable business. It looks like the trend is back to a growth trend now that COVID is fully behind us. Like what sort of, again, as an investor watching the business right now, what should we pay the most attention to make sure that you're sort of still on that track? Is there metrics or catalysts or anything that you think could be helpful to investors to pay attention to?
Well, look, if I was looking at us, I would be paying attention to the revenue growth, the segmented revenue changes. So, you know, be careful not to get caught up in like, oh, total revenue is, you know, is up by this or down by that. Okay, yeah, but how much, you know, if you don't include Ardent, for example, what does it look like, right? How is the software doing? You know, so you know, a little more intelligent. I would look at an intelligent view of the revenue growth and not just the highlight number that's on the, you know, the top of the press release, because the devil's going to be in the details with a lot of the retooling that we've done. I think that the gross margin, and the gross margin does vary by quarter. So there has to be some quarter-over-quarter as well as year-over-year analysis, because there can be seasonality to it, with different customer programs. But I think the margin is another thing to look at and understand what's triggering that, you know, and which we're very transparent in our documentation to explain that. But I think that looking at how those numbers are tracking, looking at how they just, you know, the overall percentage of overheads and things as it relates to, you know, are we scaling, or are we having to, you know, continue to fund every dollar? Because of course our intention is to scale. So I think those are the types of things I would certainly be looking at from a market standpoint.
Okay, perfect. And then just lastly, first, did we miss anything here? Should I've asked a question that I haven't asked? And if we covered everything, just what would you have as your key takeaway today?
Yeah, Paul, you're such a good question asker that I would never suggest in a second that you didn't cover something.
Oh, come on now. Yeah.
I'm too smart to do that. No, but you know what? I think the takeaway for me is that, for example, we had a recent bump, with the Q3 release, and things are going to come up and down. They always do, right? But fundamentally, this is a business, okay, that went into a pandemic as a $20 million business, right? And it collapsed overnight, right? It has rebuilt itself to a $25+ million business, right? And it is now trading at less than it was trading historically, right? And it has proven that it's profitable, right? It's proven that, like, people said to me, we don't care about that, we want profits. Within 6 months, we literally turned the ship towards profitability, right? I mean, like, we have a lot of control inside this company over what we do and how we do it, strategically, and it's a very well-run, controlled business. So, if any type of business with sticky recurring revenue, right? Software, for example, just taking the SaaS alone, never ignore my event marketing software business. That's 1.6 million on the run rate. That's half my market cap today, even at like 5 times, even at a low 5 times revenue on SaaS, which is pretty low, that's half my market cap, So we're trading at 0.6 times revenue at a very low, number, really, to a sticky business with recurring. It might not all be software, but it's all recurring style revenue, right? If you look, there's very little of my, and I segment it, there's almost nothing is non-recurring, right? I have recurring revenues with brands you've heard of, with household names, places you go and eat, things that you drink, household names, sticky revenue, well-controlled financial organization. We don't dilute shareholders. We only have a 25 million share float, right? And yet I trade at 0.6, and people are, and that's like a big bump. And so, and that's the one message I was kind of smiling. And look, it's not that we don't want the shares, the value to be higher, because of course we do. That's our goal. But we also understand we haven't spent a lot of time in the last few years spending our efforts on IR either, investor relations, right? I mean, I believe that CEOs can do kind of 2 different approaches. They can either approach it and say, I'm going to spend all of my time creating real value, and then I'll get that, then that value will be there. We'll find a way to get the value, but the value has to be real and I have to create it. Or CEOs can spend their time explaining to everybody how valuable they are, and then they wind up chasing what they've promised, right?
Yeah.
And we all know both those models. Anyone who's an investor knows those models.
Sure.
I can tell you, I'm very much 100% on that. I want to create the actual core underlying value. I don't ever want to be having to chase what I said the thing was worth, because that would keep me up at night, right? Yeah. Whereas if I can just spend my time creating real value, I know I can get to it.
Cameron, is there an exit strategy here? Is there an end goal?
Well, my end goal is retirement, Paul, at some point with a lot of money. So yeah, there is an end goal. Obviously, for a lot of reasons, including legal, I couldn't get into anything else if I wanted to right now. But there is definitely an end goal, and it involves a much higher stock price and me getting more money for retirement.
Yeah, perfect. Well, that's a handy goal to have for sure then. Well, okay, well, listen, this is great, Cameron. I appreciate it. We like to have you back from time to time to get these sort of updates. So I know we have a number of members that are shareholders, so it's always helpful for that reason alone. But I think you've shed light on the business a little bit more, and hopefully everybody understands it a little bit better than they did before. So I appreciate the time. We have been speaking with CEO Cameron Watt of Intouch Insight, symbol INX on the venture exchange, INXSF on the OTC. One more time, Cameron, thanks for joining us today.
Thanks for having me. Appreciate it.
Anytime. Bye for now. Trev. This is usually where Trev unmutes himself and says, okay, all good. which he probably walked away from his mic. Cameron, thanks. We'll cut it here, and as you probably mentioned, we'll send you a copy as soon as you give us the okay that everything's fine. We'll send it off to everybody that wasn't able to join us today.
All right. Thanks, Paul. Take care.
Awesome. Thanks a lot. Take care. Bye-bye. Are you back yet, Troy?